All right, advanced strategies. Earning monthly income. The key to this thing, we're going to do something called the short put. And really the key for this whole thing is I want you to see how easy it really is to learn to trade. This is not anything that's that complicated. Once you understand it and you're comfortable with it, it really doesn't take that much time in the course of your day. So once again, just to refresh who I am, if you don't know, my name is Cal. I was one of the original rising stars on something called Tastytrade, which is the largest online financial network in the world. Now, I don't put this up here to brag. What I put it up here for is to show you that I've done the work. I've worked at that, and I've spent 5,000 plus hours realistically learning this stuff. And my goal with my courses is to take everything I've learned and just distill it down to the simplest form so you can learn this as quick as possible. You don't need to spend 5,000 hours to learn this stuff. So that's my goal here. And as you can see here, if you ever want to reach me, you can reach me at cal@optiontradingforrookies.com. Unfortunately, it was the shortest email address I could come up with, so hopefully you don't cramp up while you're typing that thing. But yeah, call me, email me with any questions. I'm always happy to answer this stuff. So, trading short puts. With all my courses, I like to do something called driving the car analogy. And what I mean by that is kind of what I've explained. I've spent 5,000 plus hours learning this stuff. You don't need to do that to be able to trade. So this is essentially a car, right? But do you need to know all this stuff in order to drive a car? Of course not. Very few of us would know what 99% of this stuff is. And that's what I do with my courses. I want to teach you to drive the car. This is not important. Driving is the important part. So let's teach you how to drive. So what are you going to leave here with today? Well, hopefully a few things. We're going to teach you a way to buy stocks at under market value if you want to do that. We're also going to teach you a high probability way to earn a monthly income using options. You're going to be able to pick your winning percentage on every trade that you do. And more important than anything is hopefully the desire to learn more. Hopefully this inspires you to learn more about trading. So the strategy of shorting puts has kind of three parts to it. It's the when, how, and what. When to use it, it's going to differ depending on what you want to do, whether you want to purchase stocks or try and create an income. How to use it, we'll get into obligation, something called delta POP. Don't worry, I'm going to explain all this stuff. What to expect, managing winners and profits and losses. So don't worry, this may not make sense now. Don't worry, we're going to go into each thing in detail. So, but the important to start off with is this is what they call an advanced option strategy. It's what they call a naked strategy, which means there's undefined risk involved. So if you're new to options, if options aren't something you're kind of, been trading for a little while, if you're not familiar with basic defined risk strategies like verticals, iron condors, probably not the strategy you want to start off with, but I still encourage you to listen to this even if it is your first time you're looking at options, because you don't know what you don't know. So I want you to at least see what's out there and see that it's not that complicated once you understand it. But as I said before, every term or concept here that I'm going to cover, if I don't explain it here, it is explained in my other courses. Obviously, I can't explain everything here for you today, so I'm going to blow through a lot of stuff. And if you don't understand it, you can go to some of my courses and learn about this stuff. And here's the email address up here. We're going to email you a discount coupon that'll be good for the next couple of days, so you can buy any of our programs at huge discounts if you find this interesting enough. Hopefully you do. So this one is where I would start. If you know nothing about options, I would start right here. And this is going to explain everything you want to know about calls and puts, all this stuff. Leverage, when they expire, time frames, strike prices, bid-ask spread, directional components, buying or selling them. If you're not familiar with that stuff, this is where you go to find it. After that, if you know that stuff already, we go to basic option strategies, and there's all this stuff there. POPs, verticals, iron condors, volatility, all this kind of good stuff. But start here if you don't know this stuff. Move on to this if you do. But this will explain it hopefully as cleanly and efficiently as you can. The driving the car scenarios, like I said, how I like to teach. Whoops. Okay, so there's going to be a couple things I'm going to cover even though they're basic, because otherwise this thing might not make sense at all. So let's start with what is an option. So stock you've probably heard of. When you talk about shares of stock, you're actually buying a piece of the company. One share is one small piece of the company. An option, however, is something called a leveraged product. And what that means is one option theoretically, or actually in reality as well, in the end, equals 100 shares of stock. So one option is actually equal to 100 shares of stock. So when you're going to do this scenario, the shorting puts, obviously if we're talking about options, you would want to make sure you have enough money in your account to buy 100 shares of whatever stock you do this strategy on, because there may come a time where you either want to buy it or you're forced to buy it, and I'll show you. So you can't do this on stocks you can't afford to buy 100 shares of. That's a super important point to remember. So buying stocks, buying shares are synonymous terms. We usually say like buying 100 shares of stock. In this case, like I said, we're going to be talking about mainly options. But that's the difference between shares of stock and options. Options are leveraged products. Stocks, shares are not. So there's two basic rules we're going to use when we start trading this kind of stuff. The biggest one is something called duration over direction. And what I mean by that is we want to give us time to be right. So trading rule number one, and these are just rules, they're something I've learned, the driving the car. You don't have to know why. If you want to do the research and look into why, absolutely I encourage it, but you don't have to. I'm kind of giving you the rules here. We want to trade as close to 45 days as possible. Never less than 30, and we prefer not more than 60, but we're fine with 60 as well. So 45 is kind of our wheelhouse of perfect. So coming over here to a potential trade page, what they call an option chain, which is where you see all these different months. You can see this is old, obviously, but not to worry. September, October, December, and in parentheses, these are days to expiration on this web platform. And you see 9, 37, 100, 128, etc. So hopefully knowing now this is the rule, trading as close to 45 days as possible, if we were going to make a trade, we are going to use this option chain, the October one with 37 days left, because that fits our rules. It's close to 45. Above 30, below 60, and close to 45. So this is the option chain we're going to use. That's duration over direction. Volatility. I'm a volatility-based trader. I'm not going to get into a huge amount of details now, but I think it's important to understand what volatility is. So volatility refers to how volatile a stock's price can be. So easy enough, if something has high volatility, it means the stock's price is volatile, and it can move up or down dramatically. Here's the key. More volatility, higher volatility means it's more expensive. Less volatility means it's less expensive. So we're going to be doing something called selling short puts, selling puts. So when we sell something, what do we like to sell it for? Well, we like to sell things for as high a price as possible, right? Because obviously you want to sell something expensive, you want to buy it cheap, you want to sell it expensive. So the way we realize how something is expensive is by volatility. So that gets us to trading rule number 2. We prefer to sell puts when the volatility rank, don't worry about these terms, I'm going to show you examples, is greater than 50. Greater than 50 means it's a high volatility stock, which means it's more expensive, which means we're selling it at a premium. Now you can't work out volatility on your own. You have to have software that shows you. The only two softwares that I know that do this are ones called Tastyworks, and TD Ameritrade has a platform called Thinkorswim. We're going to be playing off this one today. This is the one I use. I actually use them both, and there may be more trading softwares that show this as well. I just don't know what they are. So these two definitely have volatility rank as part of their software, so you don't have to figure it out. It'll tell you. So once again, we prefer to sell when the volatility rank is greater than 50 because that means we're selling it for a lot of money. So just to illustrate volatility on a trade page, and don't worry, there's many platforms I'm using here just for ease of viewing. But I want to show you here what volatility actually means in reality. And all I'm going to do is I'm taking two stocks here. They're two different stocks. This is Yahoo, which you probably heard of, and this is just an ETF called XLK or something like that. Not important. The important part is they're both, at this point, trading for the same price. See how they're both $41. Okay? So we're going to go over here to the strike prices, and we're going to use the same two strikes, 41 and 42. So same price for both stocks, Same strike prices for both stocks. So you would expect that the options would be about the same price. Well, if you look here, you see not even close. Both of these are well over $2, and both of these are $1 or less. Whoops, what happened there? It erased. Let's try that again. Don't worry about that. So you can see these are expensive. These are like half the price or less. That's what volatility does. Same price on the stock, same strike prices, and yet these options are way more expensive than these. So if we're looking to sell something, when we sell something, we collect the money up front and it's expensive. Obviously, we want to sell these. We're getting a lot more money. That's what volatility has to do with trading. So let's keep going. And like I said, there's a lot here. All this stuff is explained in detail in my other courses if you don't, if it doesn't make sense right here. So definitions, things you're going to need to know with us moving forward. Probability of profit, when I refer to this from now on, I'm just going to use POP as the abbreviation. All that means is the probability of making at least $1 profit on this trade. So it's the probability of being profit, the probability of making at least $1 profit on this trade. That's what POP means. A shortcut to POP is something called delta. Don't worry, we're going to illustrate this too. Break-even price is also synonymous to something called cost basis. The break-even price on an option is the part where the buyer and the seller of the option make no money. It's basically a dead heat. If you bought the option, you made no money when you sold it. If you sold the option, you made no money when you bought it back. Everybody breaks even. The formula for working out your break-even price or your cost basis is real simple. All we're going to do is take the strike price that we sold and subtract the credit received. And don't worry, I'll illustrate this too. So these are just definitions. We'll show you how it works in reality in a second. So, short put, what is it? So a short put is just a put that we sell, and our assumption is just like buying stock. Our assumption when we do naked puts or short puts is our assumption is we believe the stock price is going up. So if I were to buy a stock at $100 a share, what happens when the stock goes above $100? Obviously, everything above $100 is my stock profit potential, right? If it goes up $1, I make $1 per share, etc. 2, I make $2 per share. Now, the odds when you buy stock, whether you want to believe it or not, are 50-50. Nobody knows what's going to happen tomorrow, okay? The same, there's just as much chance of going up tomorrow as down, so it's a 50-50 shot. It's a coin flip when you buy stock. And you only make money if the stock goes up from 100. You buy it at 100, you only make money when the stock goes up. But your profit potential is potentially unlimited because we don't know where the stock can go to. And that's why people buy stock. You buy it for $100 and you're hoping it goes to 200. What's the reality of that? Well, it might take 5 years for it to do that. There might be something crazy happens tomorrow, but realistically, it's not going to happen overnight. Most people buy stock and they hold it for the long term like a Warren Buffett. In this case, we're looking to get returns much quicker. So, what's a short put look like? So, here's the stock at $100. In this case, what we're going to do is, instead of buying the stock for $100, we're going to sell a short put with a strike price of 90. Now, what does that mean? That means that if the stock price closes above $90 when this expires, everything we sold the strike for, we get to keep. So in this case, we're just going to make an assumption. This is just hypothetical. Let's just say we sold the short put for $5. So we sold the 90 strike for $5. What that means is, at expiration, if the stock price closes above 90, remember, it's at 100 when I make this trade. And in our example, we were 37 days away, let's say. So 37 days from now, as long as the stock stays above $90, I keep all $5. And remember, options are leveraged, they're times 100. So $5 is actually $500. So whenever I talk about terms here, like when you see on the trade page dollars, it's actually times 100. So at the end of 37 days, I made this trade when the stock was 100. As long as it stays above 90 in 37 days, I'm going to keep 500 bucks. Pretty cool. And we can obviously see that my odds of winning should be higher than buying stock because I'm way down here when this thing happens. Stock's way up here. Obviously, my chances of making some money have to be higher than buying stock because, like I said, the stock price is already $10 below. The strike price, sorry, is $10 below where the stock price started. So let's keep going. Short put profit. We get to break even or cost basis, synonymous. So how does that work? Well, remember we talked about strike price, which was 90 in this case, minus the credit received, which is the $5, equals 85 bucks. And what does that mean? That is our cost basis or break-even price. So when I sell this strike price of 90 and I collect 5 bucks, I have a $5 cushion here, which means the stock can go down all the way to 85 bucks before I don't make or lose any money. This is my break-even or cost basis price. So in the end, as long as after 37 days the stock is above 85 bucks, I actually make some money. I don't know. What will happen is anything between 85 and 90 is an exact win. So as an example, if the stock closes at 86 bucks, I made $1 because my break even is 85. So if it closes 86, I actually keep $1 or 100 bucks. 87, 200, 88, 300, etc. And you can see why then at 90, I keep all 5 bucks. 90 and above, I keep all $5 profit. So you can see now again why my chances of making money are so much higher. I have all this room as a cushion. I made this trade when the stock was way up here. Anything in this area at expiration, I actually make some money. Pretty cool. So that's why we do short puts as opposed to just buying stock outright. Our chances of making money are better. Our odds are way higher. You can see we have a way bigger cushion. Now what's the downside? This, stock profit potential. We can only make, in this case, the most what we sell it for. So $5 is our maximum profit. But if the stock were to just go crazy in 37 days and shoot up to 1,000, which we know is pretty unrealistic, I wouldn't make that potential profit. But remember, this is a time window. We're talking about 37 days. So realistically, how much do you expect the stock to go up in 37 days? I don't know. Totally your call. It's just totally a guess. But I'm perfectly happy keeping 500 bucks at the end of 37 days because in this case, the stock would have to go up to 105 in 37 days for me to make the same profit. So it still has to go up or I don't make any money, or go all the way up to 105 before I make this amount of money, which I make if it just stays above 90. So hopefully that makes sense. I know I went through it kind of quickly and it's a little complicated, but that's how a short put works. We just have way more chance of making money. The only difference is we cap our profits. We can only make what we sell it for at its maximum. That's the most we can make. So I talked about in the beginning, when do you short puts? There's two examples you're going to use this. One might be a stock you'd like to buy, and one might be when you want to create like a monthly income stream. I want you to see here the first two on both are exactly the same. In both cases, of course, we want the stock price to go up. That's our starting assumption. This is just a replacement for buying stock. Assignment, obligated to buy. What does that mean? Well, that's the thing you have to worry about with short puts, and that's why you have to decide when you go in, stock you'd like to buy or a monthly income stream. So let's look at assignment here. What assignment means is, here's the strike price we sold. 37 days goes by. What happens is, if the stock price closes below $90 at expiration after 37 days, we are going to get assigned 100 shares of stock for every option we've sold. But the key here is we're going to get 100 shares of stock assigned to us, but our cost basis is $85 a share because we still keep the $5. So even though we made the $5 here, because it closed below $90, we get assigned the stock of 100 shares. But we keep all $5. We sold 90. We sold it for $5. Our cost base is 85. That remains the same. So, as an example, if the stock closed at $87, let's say, we'll just use this as an example. It's below 90, so I'm going to get assigned 100 shares of stock. And the stock price is $87. But I only paid $85 for it. So if I were to turn around and sell it right away for $87, I'd make $200. Anything above $85 after 37 days, even if we get assigned the shares, we still could just turn around and flip it and make the profit if we want to. Because anything above 85 to us is profit. But you have to be aware that below 90, you will get assigned that stock. So that's why I said it's important to understand you need to have enough money in your account and be willing to buy 100 shares of stock whenever you do this naked put scenario, because this is always a possibility. So you want to make sure that you're happy and you can afford 100 shares of stock at $85 if this was the kind of example you were going to do, if you're going to sell a 90 strike and get down to an $85 cost basis. But remember, anything above 85, we actually still are profitable, because even at 87, we get assigned the shares at 85. But the stock might be 87, we still made some money. So tough concept to grasp maybe, but that's how assignment works. And here's why assignment is so important, because people, me included, we love trying to make easy money. So what's the one thing you want to do right away? Well, shoot, look, I'll just go to this big stock. This is price line, and you can see right here, it's selling for $16.46 a share. And if I sell, in this case, this $14.90 put, there's 46 days left on this option, but $14.90 is the strike price. Okay? So look, you would think, wow, $14.90 is so far below $16.46. This is a no-brainer. And it is actually, in this case, an 87% chance of being a winning trade. And look what happens when I sell just one put. I collect over $1,000. So in just one little trade, I can make $1,000 in only 46 days. It seems so appealing. Like, wow, 87% chance of winning. I can make up to $1,000 if things go my way. And all I have to do is the stock, which is almost $150 above where it is now, if it stays above $14.90 in 46 days, seems like easy money. I mean, how could it possibly go below that number? But remember, 87% means 13% of the time you're going to lose, which is roughly 1 out of 10 times. So 1 out of 10 times, something crazy will happen, and this stock price will actually go below $14.90. So what's going to happen then? You're going to get assigned the stock at expiration. And what happens when you get assigned the stock at a $14.90 put price? You have to buy $149,000 worth of stock. Okay, whoops, most of us can't afford that. And that's why short puts, once again, I reiterate this because it's so important, you have to have enough money in your account to buy 100 shares of stock when you do this. And that's why you don't do it on massive stocks unless you have a ton of money, because you could end up buying $150,000 shares of stock in an attempt to make $1,000. Really important to understand. Okay, so we've gotten through assignment. So let's go with this. The stock you'd like to buy again and the monthly income stream. What are the differences? Well, in the case of the stock you'd like to buy, we're looking to purchase it under market value, and we're going to try and make as much money as we can when we do that. So we're going to sell a strike that's right at the money. However, in the case of a monthly income stream, we don't want to buy the stock. This is 100 shares of stock we don't mind buying, but we don't want to buy them. So what we're going to do is we're going to sell a strike further out of the money. Let me show you what that looks like. But before we do, just a couple of golden rules for selling puts. Golden rule number 1, never sell a put strike below, never sell a put strike above the stock price. I know these are a lot of terms, But we're going to show you all this on the trade page, so it makes a lot more sense. But this is golden rule number one. We never sell a put strike above stock price. And factors involved when we do our trades, we went through a couple of them, close to 45 days as possible. We prefer volatility greater than 50. We're going to look at our POP, what's our chance of winning, and we're going to use delta to figure out our POP and pick our win percentage. And we already saw how we work out our break-even price and cost basis. So let me show you how easy it is to actually do all this stuff and how quickly it can be done. So here's a trade page. Once again, don't worry about it. It's old. So in this case, here's our stock up here, and right now it's selling for $2.32 a share. So rule number one, our strike price must be below our stock price. So what does that mean? Well, if $2.32 is our stock price and our strike price needs to be below that, $2.32 is below, right here it's actually $2.32.53 is the stock price. So we cannot sell the $2.33 put. Why? Because this strike is above the stock price, and that's our golden rule number one that we never break. We never sell a strike above our stock price. So in this case, there's our stock price. The first put we can think about selling is $2.32. And this is what they call at the money strike. It's right at the money. It's right at kind of just below the price of the stock. So this would be for a stock we're looking to buy. If we want to buy a stock, we'd sell the strike price as close to the stock price as possible. Because why? We collect the most amount of money. You can see here, as we get further away from the stock price, right? 231 is further away, 230, we collect less and less and less and less money. So if we're totally happy buying the stock, hey, let's collect as much money as possible. Volatility rank you can't see on this page. I'll show you on a live trading platform. Delta and POP out of the money. So let me show you right there, delta and POP, what that looks like. So in this case, we're going to go down here and you see delta. And you see delta. Delta you can think of as your chance of losing. Okay? I know it sounds kind of backwards. But remember, everything's out of 100%. So if I told you your chance of losing was 32%, you should tell me that there's a 68% chance of making money. My POP is 68. It's this number subtracted from 100. And you can see when we start here, delta 49, right here, probability of in the money, which means the probability of losing, I just want to show you, are almost exactly the same. That's why delta is such a good representation. If you don't have this on your platform, you just use delta, which almost every platform does. So you can see 32, roughly 32. 36, roughly 36. It's just a quick estimate. Delta is a quick estimate for your chance of losing. 40, roughly 41. These numbers are roughly the same. Not deadly accurate, but pretty darn close. So it's getting squashed in there. But we can see when we do this, we can use delta as our way of working out our POP. It's just the exact opposite. You can see if you add these two together, they roughly equal 100%. Right? 32 plus 66 should be 68, close enough. 36 should be 64, close enough. So this is our chance of making money. This is our chance of losing money. So once again, we take delta, all we do is subtract it from 100, and that gives us our POP. It's a nice, easy shorthand for working out our probability of making money in a particular trade. So let's go back up here, and we see higher POP, lower income. So let's take a quick look at that. And once again, as you saw, as we get further away from the stock price, which means there's a better chance of us making money, right? You can see down here, our chance of making money goes up as we get farther away from the stock. Makes sense. But what happens? We get less and less income, right? The most we make is right here at the money. As we get further away, it goes down. So higher POP, a higher chance of making money, means we earn a lower income. We make more money, but we take more risk because there's a less chance of winning. Higher POP, higher chance of making money, which would be this. Higher chance of making money, lower amount of money we make. Higher POP, lower income. And break-even price, cost basis, we already saw how to do that, and I'll show you on the next page. So those are our basic rules. When we look at a trade page, all we're going to do is we're going to look at the stock price, make sure we don't sell the strike price that's above it, and then are we looking to buy stock? We're looking to buy stock under market value. We're going to sell the first strike below the stock price. After that, we're just going to pick what we want based on our chances of winning and how much we're looking to collect. So let's go here up, zoom up a bit. This is the exact same thing we just looked at, but just zoomed in. So here's that 232 strike, which is at the money. And you see we collect a lot of money when we do that. But our chance of making money is small. It's about a 50-50 shot. Makes sense. You're right at the money, just like buying stock, but we collect all this money. So if the stock price closes below 232, our new cost basis is 228.64. How did I get that? I took my strike price, I subtracted out the 336 I collected, and we ended up at 228.64 per share. There it is right there. Real simple equation. So when we're looking to buy stock, we sell that one because we collect the most amount of money and we don't care. Hopefully it goes up and we collect a bunch of money. If it goes down slightly, no big deal because we're willing to buy this stock and we're still buying it at way under market value. Now what about down here, that monthly income stream? Same thing. Remember, higher POP, lower income. So we're selling a put that's further away, but there's a 65% chance plus that we make money on this trade. And if everything goes our way, we still collect $204. Not bad. Pretty good income for that stock. And our break-even price or our cost basis is way down here. So if we do get forced to buy the stock, it's at a much lower price than it was up here. Up here we're paying $228 a share because we don't mind buying the stock. Here we don't want to buy it. We're buying it for way less, but we have a 65+% chance we never have to buy it, and we just keep $200 to ourselves. So that's the difference between setting up a trade when you want to buy the stock and collect as much as you can, or try and collect the monthly income where there's a much better chance you keep it without having to buy the stock. Hopefully that makes sense. I know I'm going through it fairly quickly, but like I said, let's go to a trade page and actually see this in action. So the trade page we were just looking at was based on this platform. This is the Thinkorswim TD Ameritrade platform. So we're looking at SPY. As of today, the prices have changed. Today it's at 234.78. So what's our first rule? As close to 45 days as possible. So you can see here it's 44. This is the option chain we're going to want to trade in. We can also, on this one, look at the volatility rank. On this platform, you can see here current IV percentile is 17%. We prefer greater than 50, so maybe we wouldn't make a trade in this particular stock. We'd look around for something else, and I'll show you something else in a second. But that's our two basic rules. As close to 45 days as possible, check the volatility rank. Does it fit our rules? In this case, this isn't a must. We prefer it, but it's not a must, so we can go ahead and make a trade if we really want to. So let's look at a huge chain. I'm looking at all the strikes because I want you to see like how many strikes this stock has and how far you can go down. So you might say, well, Cal, I like that 65%, but why don't I do like a 95% chance of making money? That sounds even better, right? So let's go over here. Remember, our delta for 95 would be looking at about 5. So let's scroll down to about 5, and we'd be right here. So delta is 5, which means there's a roughly 95% chance of making money, and you see it's pretty accurate. But look what happens. As we go further away, you can see we make less and less money. So at this point, selling a put for 33 cents means we're looking to make $32, $33 maximum. But if things go horribly wrong, we still have to buy this stock at 208 minus 32. So we're buying a $200 stock. We'll be buying it, let's say, roughly 207.68, and we only have a chance of making 30 bucks. Is it really worth risking potentially buying $20,000 worth of stock to merely make 30 bucks? I would say no. There are people that play this game, so it's totally up to you what you want to do. For me, generally speaking, I like to go anywhere from 15 to 30% chance of making money, depending on the stock size and how much money is involved. So we look here. Here's 15 delta. That would usually be about the smallest I ever go to. And I'm looking somewhere in this neighborhood, 30 down to 15. And you can see, hey, okay, I collect a decent amount of money. I collect almost 100 bucks. Okay, well, 100 bucks, that's not so bad. And I've got a 84% chance of making $100 at the end of the month. Okay, well, that could be a monthly income. Not much risk and a decent return. Obviously, I'm looking to buy the stock. I'd be over here. And you can see a much bigger return, but it's a 50-50 shot. But that's how I work out where I want to sell. I just kind of pick a percentage I'm happy with, and I usually don't go below 15 because I can't collect enough money to make it worth my while. So that's how the higher POP, lower income thing works. And that's how you decide. You get to pick your winning percentage purely based on the delta. Pick a delta, subtract from 100. That's your chance of making money. Then it's up to you. Do you want to go way up here, have a 94% chance of making 38 bucks? Would you rather be down here with a 84% chance of making 95 to 100 bucks, etc.? That's how you get to pick your winning percentage. With stocks, purchase is real simple. It's the first one at the money. 234.78, so we cannot sell this one. It's above. This is the first one we could sell. This is where we would sell if it was a stock purchase. So let's go to a stock that actually has a high implied volatility. How do I know it? Because I checked it today. Just so we'd be ready for this one. So here you go. Current IV, 62%. Hey, that's great, right? It's above 50, 44 days. And the stock is much lower priced, which is also nice because not all of us can afford a $200 stock, $20,000 in shares. So let's see what this looks like. What does high volatility do? So look at this. This is only a $33 stock. But if we're looking to buy this stock, we'd sell this strike right here because it's below. And you can see we collect about $1 for doing that for a 50-50 shot. Not bad. For only a $34 stock, we collect 100 bucks right there. So if we were forced to buy the stock, we'd get to buy it at 32 in 44 days. Or if it stayed above 32, at the end of 44 days, we'd keep all 100 bucks. And once again, as we get farther away, our POP goes up. So in this case, because it's a smaller stock, you can see we can't go that far away because you end up getting virtually nothing, only a few strikes away. But here's our roughly 15 delta that I like to play with, which is an 85% chance of making money. And there, you're collecting roughly 25 bucks. Once again, probably not worth it on only a $30 stock, but totally up to you. But you can collect 40 bucks here with a 77% chance. This is how you play the game of short puts. It's really that simple. Pick a stock you like, 45 days is close to it. Look to see if the volatility is high because you'll collect more money, but you don't have to have it. And then you just pick your percentage and pick a price that you're happy with. You know, are you happy risking this much money, potentially buying a stock for 30 bucks, 100 shares, 3,000 bucks to make 40, 50 bucks at the end of a month? That's the game. But you can see it's not very hard. It's a simple system. So let's go back here. All right. So what to expect with short puts? You see how to set them up now. So what can we expect? So there's two ways we handle this. Managing winners is a big thing with trading. Now when we do a stock purchase and we're selling that at the money put, we leave this alone and we just let it expire because we don't care if we get the stock. We'd like to keep the money, but we're totally happy buying the stock at that price. However, if we're looking to do monthly income and we're looking to sell that put that's like 15 to 30 delta, let's say, or whatever number you pick, we're going to manage this winner at 50%. And I'll show you what that means in a second and why we do that. Also important to understand profits and losses on assignment, as I said. Remember, you might get put the stock. If you do, there's two things. We'll just do a quick show at the end of what you can do. You can turn into covered calls. You can do something called rolling, which is a whole nother presentation in itself. It's a long, more of a science than an art form. Sorry, more of an art form than a science. But it's something that takes time to learn. And we're obviously interested in what we're making per day would be nice too. And you'll see why in a second. So back to we sold those two things, right? So there's the original 232 put. We already saw we collect 336. We're going to let this thing expire. And at the end of 40, whatever it was, 44 days, whatever we're at, if it's above 232, and remember right now it was at like 232.50 or something like that. At the end of 44 days, if it's above 232, we keep all 336 bucks and we're happy. If it goes below 232, we get assigned the stock, but our new cost basis is 228.64. So as long as the stock closes above this number and below this number, we still made money on this trade. However, with managing winners on monthly income, what we're going to do is different. We're going to sell this thing for $204, which means we collect $204 up front. But, and I'll show you why we do this in a second, we're going to manage this at 50%. So what does that mean? Well, if we sell this thing for $204, out the gate, then 50% of that is $102. So what we're going to do is when this put can be bought back, remember we're selling it up front. Sometimes it gets complicated with people. We're selling this put up front, so we buy it back to close it. So if we sell it for $204, we've made 50% profit when we can buy it back for $102. It's the exact opposite of buy low, sell high. We all know stock market says buy low, sell high, right? But that's the exact same thing. Buy low, sell high is the exact same thing as sell high, buy low. So if we sell this thing for a premium, if we sell it when it's expensive, and we buy it back when it's cheaper, we made money. And the way we work out 50% is easy. If we sell it for X, we divide it by 2 and we close it, and we can buy it back for half of what we sold it for. So in this case, we sold it for $204. We're going to buy it back for $102, which means it's a 50% winner. That's how we set up naked puts, and I'll show you why we do this managing winners in a second. I always got to give props to Tastytrade because that's where I learned everything, and this next study is one of their studies. So this will show you why it's so important to manage. Managing winners, which is one of my programs because it's so important. So all we did in this case was we sold the 16 delta put closest to 45 days expiration, which, perfect, meets our rules, right? 45 days, 16 delta put. What does that mean to you now? If I told you there's a 16 delta, what's your chance of winning? What's your POP? Hopefully, you realize we subtract it from 100, and there's an 84% chance we win on this trade. So they compared expiration to managing at 50%. Perfect, right? We've been talking about this the whole time. Let's see it in one of their studies because it is from 2005. It's 11 years plus they did this for. So what happens? So let's look at stock first. This is like essentially selling that at the money put, if we were to say, but this is buying stock. So we buy stock at expiration. You can see, selling 16 delta trade at expiration. So we let this go to expiration. What happens? Well, we make a lot more money because it goes to expiration. We were expecting an 84% chance of winning. We got to 94. Pretty cool, right? 10% more than we expected. and our largest drawdown was 947. So by letting it go to expiration, we made more money, but we also ended up having a bigger loss, which makes sense because we probably got assigned stock a couple of times. Over here, if we do the monthly income system, if we manage at 50%, in this case, we made less. Look what happened here, though. Our percent of winners went up to 98%. We only lost on 2% of the trade. That's even more awesome. And our drawdown was much less. So what they call managing winners, managing early, managing at 50%, we still make a good amount of money, not as much as going to expiration, but we limit our losses. We have a much higher chance of winning, and even better, our profit and loss per day. So if you took out how much money, you take all this money, on each trade you just divide out, like, what am I making per day? Because I'm closing these things early, right? This is going for all 45 days. This may be closed 10 days later, 20 days later, 25 days later, who knows? But it's a lot less time. So when you divide out how much you made divided by that time, you end up making more per day by managing winners. And remember, let's say this thing closed after 25 days. So we made this trade, we took our 50% winner, we ended up making 272, which is almost double what you made by waiting till expiration. We can turn around and put on another trade. So we could potentially put 2 trades on in the same amount of time as this expiration trade took. So we could, in theory, if everything went our way, probably double this number compared to this number with a higher POP, higher profit per day, and less risk. Well, hey, that's great, right? So that's the difference between buying stock, holding the expiration, you probably make more money, but you have bigger drawdowns. Managing winners, let's get out of this because it's so busy now. Better chance of winning, lower losses, and you make more money per day. So you can put on more trades and flip this again and do it. That's why we manage puts, because it makes sense. We make money, we have a higher win percentage, higher per day, and less risk. Who doesn't want that? So, obviously I always like to push my stuff. Why wouldn't I want to? But also because I think it's important. As I mentioned, managing winners, making trades, managing trades, that's really the key to trading. Once you understand how options work, and once you understand different strategies like verticals, iron condors, naked puts, short puts, things like that, really trading comes down to this. When you make your trade, you want to do it correctly, and that's based on these things, which is picking the right stock, liquidity, avoiding earnings, volatility, etc. And then really the key to trading long-term, the way to make money trading long-term is all about management. Things like trade small, trade often, position sizing so you don't get blown out by making trades too big, drawdowns. You know, what happens when you make a trade too big, it makes sure you could take a big hit and that could set you back a long time. Trading is all about singles versus home runs. We're not looking to make a killing, we're looking to make that consistent money again and again and again. I always talk about single versus home runs. You just want to hit singles every day. Singles, singles, singles. If you can make a lot of money, it generally means you can lose a lot of money. So we'd rather be able to make small amounts lots of times, because that way if something goes wrong, it's also losing small amounts a couple of times. So singles over home runs. Duration over direction gets into that 45-day window. And the key to trading above all is managing winners. This is really the key to being a successful trader. If you don't manage winners, then you're just letting the market do its thing and play out its probabilities. Managing winners, you just increase your chances of making money more consistently. So I highly recommend whether you that you take a course like this, preferably my course, to learn how to make and manage profitable trades, because that really is in the end the key to making money. And we're going to send you coupons, you know, so you have more incentive to try and take these things, because it's really, really important. So just real quick, I want to do a quick look at long stock versus short puts, because theoretically they're the same thing. They both assume the stock price is going up. So why do you do one over the other? We've kind of been through the whole thing, but I want you to see it kind of side by side. Just out the gate, I want you to look at just the size of the goods versus the bads. So look, long stock, here's the benefits. Short puts, here's the benefits. Long stock, here's all these drawbacks. short puts, here's these few amount of drawbacks. So what are the big differences? Well, benefits, why do you buy stock? For one thing only. Mainly for this unlimited upside exposure, which means the stock can go to the moon, you make a bunch of money. Some people would buy them to collect dividends. That's great too. But for most of us, we usually buy stocks hoping they go up over time. But the downside to that is when you buy stock, it's a 50-50 bet because you're not increasing your cost basis. You're buying stock at market value and you just hope it goes up. And buying stock is expensive, right? You can't buy $500 or $600 stocks, thousands of shares of them. But with puts, as long as you're okay getting stuck with 100 shares if you had to, you could sell a put on a $200 stock because depending on how you set it up, there might be like only a 10-20% chance you're ever going to get the stock. So as long as you can afford it, most of the time you're not going to have to buy it and you can still make money. Benefits of short puts, obviously we sell these things and we collect money up front. If we get put to stock, we get to buy at a lower price because of our cost basis or break-even price. And as you saw, we make money. Even if the stock goes down, we can make money. Right? When you buy stock price goes down, you instantly lose. With puts, you saw we have a cushion. We've got our strike price, and we've got that credit we received. So we've got that nice big cushion of profit window. So obviously with upsides come downsides. We have limited profitability. That's the big one. Again, dividends are always there. Dividends are always there if that's why you're buying stock. But really the biggest thing is stock, you have unlimited upside, whereas selling puts, you can only make what you sell it for. That's the big difference. But the benefits are huge, like you see. Better chance of making money. If you're forced to buy stock, it's at a much lower price, and it's not capital intensive like it is for buying stock. So, as I said, what to expect with short puts. If you get assigned, what can you do? Well, if you want to continue making money, then you can do something called a covered call, and I've made a course designed just to talk about that. So if you have stock, if you own stock already, or if you get assigned stock, you want to immediately go into covered calls, which gets in the process of selling calls against your stock. I'm not going to get into it here, but I have a program that will show you how to do that. So even if you get put to stock, this is a way to start making money off your stock every month as well. You can also do something called rolling, as I mentioned earlier. This is a much longer presentation, and it's much more complicated. I encourage you to look it up on the internet, but it's not something you're going to learn in 5 minutes. It's, like I said, this is an art form. This is something you only learn to do as you trade more and more and more. You can't just read it in the book. You can kind of read what it's about, but to learn how to do it takes time. So for the most part, assignment to us is going to mean covered calls. And if you want to learn how to do that, like I said, I highly encourage you to take this course. So even after you get put to stock, if it happens, you can keep making money on the stock you now own. And here's everything I've done up to now. Here's the website. In case anybody's interested, I'm going to be coming out with an alert system in May. So if you want to learn to trade, basically I'll send you a trade every day. I do the research, trades I make every morning about the time the market opens. I'll look through the market, find the best trades, and shoot you a trade alert every day that you can use or not use, but at least you can see what I'm doing, and you can follow along with me if you want to make the trade itself. If none of this stuff makes any sense or you just want to learn it or refresh it, I highly recommend these 3 courses, and they go in this order. So it's almost like 1, 2, 3. This is going to explain everything you need to know about options and how they work. This is going to tell you how to trade verticals and iron condors. And this, as I mentioned, is how to make and manage profitable trades, which is really the key to trading long-term in the end. If you already know this stuff, then I made a course on variations on iron condors, like 6 different variations on iron condors and when to use them. And also, as I mentioned, covered calls would be something you do if you get assigned the stock. This is how you handle it. This is how you keep making money even on the stock you just got assigned. So we're right at about that hour, so it looks like I hopefully nailed it. My goal is when I brought you here today and you came here was to teach you these few things: a way to buy stock at under market value, which would be the equivalent of selling that at the money put, so you collect the most money possible. And if you get put to stock, you get it at a much lower price because of the cost basis break-even price reduction. A high probability way to earn a monthly income using options would be selling those out of the money strikes. The further away you go, the better chance you have of keeping the money, but the less money you get to keep. Remember, higher POP, higher chance of making money, lower income. And by using delta, you saw the ability to pick your winning percentage in every trade. All you do is take the delta, subtract it from 100, and that's going to give you your chance of making money on that trade. A nice, simple, easy tool to use to work that out. So hopefully, if nothing else, you found this interesting and seen that it's not super complicated to trade. Again, these were naked option strategies, which is more advanced strategies. So you can see, once you know it, you can see how fast I blew through it and how fast I can decide what trade to do because I know the rules. But there's not a lot of rules, and it's not that complicated. It's more about understanding what you're getting into and the confidence to do it over and over and over. So hopefully, if nothing else, you've got the desire to learn more, having seen now that it's not rocket science. And of course, as I mentioned, I love to answer questions. So if you have any questions about any of this stuff, please feel free to email me. I'm always here as a resource. Again, this is the longest email address I could find, so hopefully you don't cramp up while typing it in. But that's it. Hopefully this has been valuable to you. If you guys have any questions, real quick, I'd be happy to answer them. Otherwise, feel free to hit me up tomorrow or anytime today or whatever. Email me any questions you have once you've thought about it, or go back through and get stuck. And you'll be hearing from us as well about getting coupons if you want to learn more by buying our courses. And also my partner does technical analysis. So if that's something that appeals to you as well, you'll also get coupons for that as well. So thank you so much for joining me. This has been awesome. I love teaching people. Hopefully you found it valuable. Like I said, if you got any questions, go ahead and shoot them to me now. If you don't, I'll turn off in a few minutes. And like I said, you feel free to email me at any time. I'm always happy to answer them for you. Thanks.